Brexit has brought new uncertainties to the global economy. It means pain for the UK, which is about 2% of global output, and for the Eurozone, which is about 12%. Process is still unclear, but we think there's going to be a recession in the UK due to the drop in investment, drop in hiring, damage to trade, damage to the City of London. Some offset because of the plunge in sterling that we've seen over the past week, but overall you must expect recession in the UK. Europe, we think, will be less damaged, but will have some degree of pain. But there, the financial system still looks solid. And the real concern in Europe is the existential one of whether some other country wants to follow the UK's lead. Doesn't seem likely at the moment, but you can understand the concern about it. Outside the UK and Europe, not that much impact. You'll also have a policy offset where we're going to see the Fed delaying rate hikes, maybe until December, maybe even until next year. And also in Japan, action to defend the 100 level against the dollar if necessary, and also a bigger fiscal stimulus than people had been expecting. So overall, you have to take a more negative view on the world. There's nothing positive that comes out of this, but you need to see it in perspective. You're talking about 1/10, maybe 2/10 of global growth this year and next year. It's not the beginning of a new economic downturn.
In an outcome that a large majority of investors had discounted as a very remote possibility, British voters voted last week to leave the EU. As unthinkable as it may have seemed only a week or two ago, the reality is now that the process of disengagement from the EU, whatever that may mean, is pretty much irreversible. In the immediate aftermath of the vote, markets have taken a predictable reaction, being in shock. The assumption was always that the Remain vote would win, but this didn't occur. So what we have decided to do is to give some conclusions, however tentatively, what we're going to do in the aftermath of Brexit. So the first important thing to keep in mind is that there will now be additional volatility. We have voiced our concern before about market volatility, and this just essentially, it underscores our concerns held previously. Into the vote, our recommendation was for portfolios to run neutral currency allocation in equities. We are sufficiently concerned about the possible contagion effects around Europe that we have decided to downgrade European equities to underweight, albeit with a relatively modest 3%. This reflects the broad view on the macro risks posed to the strong possibility now of an economic recession in the UK. For other equity markets, we maintain weights on the view that apart from the volatility, the fallout should be contained at least for now. Our bias for the new future, barring additional surprises, would be to continue to look for opportunities to add diversification to portfolios in other equity markets, especially if lower entry levels present themselves. In fixed income, we have reflected our increased caution by downgrading developed market high yield to underweight, this being due to the fact that their correlation to equity markets is the highest in the fixed income spectrum, and therefore they would be somewhat more exposed to tail risk. We've also upgraded investment grade bonds from developed markets on the basis that while they may be fully priced, they offer a solid defensive bias in portfolios in a period of equity market volatility.